Not a ton of upside this morning for Hasbro. Shares of the toy maker falling after reporting fourth quarter earnings that missed expectations. Revenue declined 23% to $1.29 billion. Adjusted earnings per share, that came in at 38 cents versus the 64 cents that the street was looking for. Full year guidance for 2024 also disappointing investors. For more on the results and the year ahead, for Hasbro at least, and plus some of the other toy makers, we've got Zachary Warring, who is the CFRA Analyst. Great to have you here, Zach. Let's first start with Hasbro here. I mean, it feels like, and our team in our newsroom meeting thought I was joking this morning, but hey, Wizards of the Coast, my goodness, that segment at least growing 7%, but there's some other warning spots within this report. Want to get your read.
Yeah, I think for us, we see this as kind of a throw in the towel quarter. They took a bunch of impairment charges. Obviously, big revenue miss, bottom line miss. So, miss across the boards. Guidance was very conservative, we think. So, we think this quarter was kind of throwing the towel. Let's set expectations low going into 2024. And we expect them to beat throughout 2024. We think they've given conservative guidance and they can beat easily.
And Zachary, we know that in that earnings report, we saw CEO Chris Cox talking about, they have a healthier balance sheet entering into 2024, leaner cost structure, diverse portfolio here. When do we start seeing that pay off, I guess, longer term here? What are investors hoping for that they didn't get from this earnings report?
Yeah, I think what the big thing was with the balance sheet was inventories are now back down to below 2019 levels. They've started to pay down some debt. They've got some debt coming due in November, which we expect them to pay off, and not refinance. And we think now, they've kind of laid the groundwork to, make some slow improvements through this year. They've guided for basically down 5% revenues and some improvement to operating margin. So we think the next few quarters are going to be big for the company. We would worry if next quarter they reported a similar write down some impairment charges or goodwill. That would concern us, but we think that this is kind of the throw in the towel. Let's reset, and now we can be going moving forward.
This is a company that's targeting 20% adjusted operating profit margin by 2027. How much of that banks on the digital gaming segment and the licensing that they're able to take on there, and the build out for end users to flock in and perhaps make purchases on the content, and then in-game or in-experience purchases as well?
Yeah, that's huge. Digital is the only way that they can get to 20% operating margin. Obviously, you're not going to get that from consumer products, which is currently their largest, percentage of revenues. So, digital is huge, and that's where they're investing a lot. Obviously, they've had success there. They are, however, expecting revenues to be slightly down this year because of some second half comps on licensing agreements. But, we think that's where they're going to get it. Entertainment, obviously, is now going to be much smaller as they've sold off their non-core entertainment business. So it's going to have to come from digital. Consumer products, obviously, that doesn't carry anywhere near a 20% operating margin. So you're exactly right.
And of course, Zachary, Mattel has been on the minds of everyone, of course, because of the Barbie push as well. But you have a hold on Mattel and a strong buy on Hasbro. How do you see those stacking up against each other?
Yeah, I think the difference is, it's hitting the horse on the head here, but digital. So that's kind of the difference between the two companies. Mattel has done a really good job in recent years to kind of expand margins and be a more efficient company. And Hasbro hasn't. So, we liked Mattel a couple of years ago. They benefited from, some costs cuts, and now we think it's Hasbro's turn. We also, like I said, we like the digital. So that's kind of the difference between the two for us.
Just lastly, while we have you here, I mean, when we think about the number of films that are in the coffers for Mattel, what does that look like in terms of Hasbro and trying to make sure that on the content side, they've struck the correct deals in order to get and stay in front of fans out there that drives even more toy purchases?
Yeah, we think entertainment's huge. So it all ties in. So if you've got a bunch of kids watching your TV shows and movies, they're going to go out, their parents are going to buy them those products that they love. So, we thought that was why they bought E1, and it was. However, E1 had a significant other business that wasn't, geared toward maybe Hasbro's consumers. which they've gotten rid of now, and we think they'll start to really focus on those core TV shows and movies that are driving sales for their consumer products business. And it's huge. Mattel's done a really good job. Obviously, the Barbie movie was huge. Didn't really target their consumer. Mattel, targeted maybe a more of an adult to watch their movie for Barbie. But, we like Hasbro. We think they're targeting the right audience. Barbie obviously drove a lot of sales just because it was just huge all over the U.S. But we like Hasbro more just because they target their consumer, their younger, 1 through 15 age kids. And so, we think it's huge. It's a big part of their business.
Zachary Warring, thanks so much for taking the time here to break down all things the business of fun, the toys at the end of the day, things that we all grew up on. Zach, appreciate the time.
Thanks for having me.